Good day. The first topic is what is analysis and what is the purpose of it. One of the things that distinguishes this course from some of your basic courses is that you were learning different tools and techniques, and you learned things because you were told you needed to learn them. When we get into analysis, purpose becomes the most important part. It's about thinking. There's not a clear answer to what we're doing. Now, let's start with the difference between financial reporting and financial statement analysis. Financial reporting is providing financial information about an entity to enable users to make decisions. Its financial information includes financial statements and other types of reports, so it's reporting information to you. Then there's financial statement analysis. That's using financial information to assess the prior performance in order to make decisions about the future. So it's using financial information to assess prior period performance and assess the likelihood of future performance to make decisions. So now, when we start with that, what is the purpose of analysis? In all cases, we do analysis for a reason. Okay? There's a purpose. And the first is to make a decision. And the decisions fall neatly into three categories. We analyze financial statements in order to decide if we want to lend money, issue debt. Second is an equity investment, from a controlling to a non-controlling to individual shareholding. Then allocation of capital within the firm to make decisions on how should we allocate our capital to what projects so that we can generate a return for our stakeholders. So you make a decision. Those are the three: issuance of money, equity investment, allocation of capital. Then you make a recommendation on what to do. So you analyze for a purpose and then make a recommendation. Let's just take a quick look at internal analysis, allocation of capital. There are so many different roles in finance, and when we look at some of this internal analysis that happens, is about managing the cash flow of the company. It's about profitability reporting, either at the business unit level, geographic level, product level, about capital structure. How should we fund the company? What was the relationship? How much debt should we have? How much equity should we have? Gets into pricing decisions. How should we price our products? Planning, short-term and long-term. Many of these we're going to talk about as we move forward. Then there's capital budgeting. What type of fixed assets or large expenditures should we make that are going to benefit future periods? Acquisitions. Should we acquire another company? When we look at buying a company, we're going to look at, well, should we buy it? How does it fit? How do the numbers work? Now, gets into the area of compensation. Many executives are compensated based on the performance of the organization. Risk management. You need to identify the risk, quantify what the potential impact of the risk is, and then how do you mitigate that risk? So internal analysis is all about these things. There are so many opportunities within the firm to do that. From an external perspective, it's a credit perspective. Decide whether to lend money, but more important, how to structure it so that the payback works. When you're lending money, what you want to do is make sure you're going to get repaid, number one, but make sure that the payment terms work for the borrower so that they will be able to pay it back. So you're evaluating their ability to repay a loan. So you're looking at what historically that's been, and you're going to look at what the future is going to do. So it's, do you want to do it? But then you're going to get into, how do we structure it? What type of loan should it be? We may get to that, we may not. And then lastly, what price it would be. The equity perspective, buy a controlling share. We've seen a lot of acquisitions lately. Buying a partial interest. analysts to make a recommendation on the company. So we have people who make recommendations, study companies, and make recommendations to either individual investors, and they're called buy-side or sell-side. Buy-side analysts are those that work for either a fee or they work for the entity that's going to buy it. Sell-side, primarily your big investment banks, will provide analytical support and analysis and recommendation to investors, but they're trying to drive business. They're both incredibly useful. So that's the type of analysis that's done. Now don't go back, and I'm going to run this all the way back here. Very important. This is the foundation of what you're doing. We're doing it for a reason, a purpose. Okay? Keep that in mind as we go through all of this. From a CFA perspective, the CFA Institute actually defines financial analysis. They define it as the process of examining a company's performance in the context, key, right there, see that? Context of its industry and economic environment in order to arrive at a decision or recommendation. And there's quantitative information that supports the analysis, and then there's the qualitative information to support that assessment of the overall business model and sustainability. It's not just about the numbers. We're going to look at things that, what does that have to do anything with it? But it's very important so that we can understand the financial numbers in context of what the firm is doing. And sometimes when we go through this review, it's a recent events exceptions to the norm. Are there unusual items? What are the company's overall long-term prospects? So that's what the CFA Institute defines financial analysis as. Now the next thing, this is a hard one. There's a principle, Pareto, and what he studied is that 20% of our actions give us 80% of our results. So 20% of our actions give us 80% of the results. Now, if 80% of our actions only give us 20% of our results, we should focus then on the vital few. Now, you are going to see as we go through this course, there is a massive amount of data and information you're going to see. We don't need to look at every piece. We need to narrow it down and focus on those 20% of actions of items that are going to give us 80% of the results. We need to focus and tie the pieces together. So as we're doing this, I'll remind you about Pareto, but 20% of our actions give us 80% of our results. So if we could stay focused as individuals, myself very much included, we'd get a lot more done. That's Pareto. So we're going to take this big, huge amount, we're going to filter it through. There's different phases in financial statement analysis. The first is to articulate the purpose and context. Then you collect data, you process data, and then you interpret it and analyze it. What is it telling? Then you develop and communicate conclusions and recommendations and follow up. Plan, do, check, adjust. Okay? So what we just did is we're starting to talk about articulating the purpose and the context. So again, when we're doing that, the purpose of analysis is to evaluate the historical performance of the company using different methods, prepare a forecast of future performance, value a company's equity or debt, prepare a rating or recommendation. To do that, though, we need to define the context. Who's the audience? What is the end product? What is the time frame? What are the resources and resource constraints? Based on a purpose and context, formulate an approach and key issues. So this is where we're starting as the purpose of financial statement analysis. Please let me know if you have any questions.